China's car market faces overcapacity as zombie factories multiply. Tianjin coach rear-ends bus, both vehicles burned to skeletons. Why does the CCP say Vanke but not Evergrande? Experts analyze. After the bankruptcy of Sichuan Trust, investors suffer severe losses and are restricted in their movements. Credit Suisse reportedly dissolves its China wealth management division, dozens leave. It's all covered in today's China Truths. China's car market faces overcapacity as zombie factories multiply. In 2017, Hyundai Motors invested $1.15 billion to build a new factory in Chongqing with the aim of reaching an annual production of 300,000 gasoline vehicles. However, 6 years later, Chinese consumers rapidly shifted towards electric vehicles, leading to stagnant sales and forcing Hyundai to sell the plant last December for less than a quarter of the investment amount. Lee Hang-koo, the head of the Jeonbuk Institute of Automotive Convergence Technology in South Korea, said, "The Chongqing factory has been continuously losing money. The Chinese car market is facing an oversupply issue, and nobody wants to buy this factory at a high price." Analysts predict that in the next 10 years, China's automotive market will see hundreds of zombie factories. According to data from the Shanghai consulting firm Automobility, last year China produced 17.7 million gasoline vehicles, a 37% drop from the peak in 2017. Bill Russo, the founder of Automobility, stated that the cliff-like decline in gasoline vehicle sales means that up to half of the industry's capacity, or about 25 million vehicles capacity, is not being utilized. While some factories will be repurposed to produce hybrid or purely electric vehicles, others will never produce cars again, posing problems for both Chinese and foreign enterprises. Russo said that many automotive groups in China face two choices: let the factories halt production, or manufacture some vehicles and then export them to Russia or Mexico. Due to the plummeting sales of gasoline vehicles, Hyundai Motors and its subsidiary Kia saw their total sales in China drop from nearly 1.8 million units in 2016 to 310,000 units last year. The fierce price wars in China's automotive industry put additional pressure on traditional car manufacturers, with even Toyota, Volkswagen, and General Motors quickly losing market share. According to a report by China's First Financial, among 16 Sino-foreign joint venture carmakers, only 5 had a capacity utilization rate higher than 50%, and 8 were below 30%. Some foreign brands also try to export more products from Chinese factories. However, experts say that doing so might weaken their factories in other markets. Tianjin coach rear-ends bus, both vehicles burned to skeletons. Following a massive explosion in Yinjiao, Hebei Province, on March 15, a collision between a coach and a public bus in Dongli District, Tianjin, resulted in a fiery blaze. The fire raged fiercely, with thick black smoke billowing and turning the area into a sea of fire. Both vehicles were burned to skeletons, leaving behind only charred remnants. Tianjin police reported that at 6:37 a.m. on March 15, a coach rear-ended a public bus parked on the side of the road due to a malfunction, causing both vehicles to catch fire at the 24.2-kilometer mark on the eastbound Jinhai Highway in Dongli District, Tianjin. The accident resulted in the death of the coach driver and injuries to 37 others. The cause of the accident is still under investigation. Mainland netizens raised concerns about vehicle safety and speculated about the causes of the intense fires in recent accidents. Some questioned whether electric vehicles were involved and suggested banning them from the roads due to safety concerns. They humorously referred to trams as mobile incinerators and questioned the severity of the collisions that led to such intense fires. Reflecting on recent events, they remarked on the recurrence of accidents in the Beijing-Tianjin-Hebei region and dubbed the year 2024 as a year of fire, expressing worry about the frequency of incidents in the area. Previously, on March 13 at 7:55 a.m., an explosion occurred in Yinjiao Town, Sana City, Langfang, Hebei Province, with the violent explosion almost leveling a 4-story building, leaving behind only a severely damaged frame. According to the official announcement from the Chinese Communist Party, the explosion in Yanjiao, suspected to be caused by a gas leak at a fried chicken shop, has resulted in at least 7 fatalities and 27 injuries. Due to the CCP's tendency to conceal disaster information, there are doubts about the official death toll and injury figures. Why does the CCP say Vanke but not Evergrande? Experts analyze. Vanke Group, a prominent Chinese real estate firm, faced a significant threat to its existence by 2024, struggling with debt default risks that led Moody's to demote its credit rating to junk. In response, the CCP intervened in an unusual step to assist Vanke through its financial turmoil. This move highlighted the CCP's different treatment towards state-owned and private enterprises, emphasizing the importance of preserving its image and preventing the collapse of Vanke, unlike its approach with Evergrande. On March 9, N.I. Hong, the Minister of the Ministry of Housing and Urban-Rural Development, stated that companies with serious insolvency issues or those that have lost their operational capabilities should go bankrupt or be restructured as necessary. However, a few days later, the CCP intervened, requesting 12 banks to arrange a syndicated loan of 80 billion yuan, approximately $11 billion, for Vanke Group, which has state-owned assets, to help it overcome the debt default crisis. Vanke has a state-owned background, with its largest shareholder, Shenzhen Metro Group, being a state-owned enterprise directly managed by the Shenzhen State-Owned Assets Supervision and Administration Commission. Wang He, an expert on Chinese issues, told the Epoch Times, because of Vanke's state-owned background, the CCP cannot easily let it collapse. Compared to Country Garden and Evergrande, the CCP's support for Vanke is unprecedented. This also reflects the authorities' different treatment of private and state-owned enterprises, as well as the real situation of enterprises of different natures in China currently. Xia Tian, a professor at the Aiken School of Business at the University of South Carolina, noted that Vanke's state-owned background makes it incomparable to other private real estate companies. He told Radio Free Asia, the CCP cannot allow Vanke to fail because it treats insiders and outsiders differently. Involving state-owned assets and the failure of the State-Owned Assets Supervision and Administration Commission would be tantamount to national capital bankruptcy, which would raise doubts about the CCP's ability to manage enterprises and affect the entire national image of China. The CCP wants to preserve its own dignity, and for other private enterprises facing the same issues as Evergrande, the CCP cannot and does not want to save them. Evergrande, Vanke, and Country Garden are known as the 3 giants of the Chinese real estate industry, but their fates are starkly different. The CCP's choice not to save Evergrande and Country Garden aims to create a benchmark for handling debt issues in the real estate sector. By not intervening, the CCP intends to establish a debt restructuring model for companies in similar predicaments, encouraging creditors to negotiate by highlighting the risks of non-compromise. This strategy underscores the CCP's emphasis on financial discipline and accountability, setting the stage for addressing larger industry-wide debt challenges. Vanke has prioritized repaying its foreign debts in the first half of 2024, amidst a peak in its debt repayment schedule, including significant amounts in both foreign and domestic obligations. This strategic decision aims to stabilize market confidence and demonstrate a commitment to international creditors. This approach reflects a broader pattern in the Chinese real estate sector, where repaying foreign debts often takes precedence over domestic liabilities, especially in scenarios of limited liquidity and challenging sales environments. Taiwanese economist Wu Jialong highlights that this prioritization serves to protect the interests of the elite and politically connected individuals who invest in high-interest overseas bonds. This tactic not only ensures the protection of these investors' interests but also helps real estate developers maintain favorable relationships with influential figures. After the bankruptcy of Sichuan Trust, investors suffer severe losses and are restricted in their movements. Foreign media recently revealed that after the bankruptcy of Sichuan Trust, many investors who had put their life savings into it have lost everything and are in a difficult situation, even being restricted in their movements and not allowed to leave Chengdu. According to a report by the Associated Press on March 13, Chengdu-based Sichuan Trust went bankrupt in 2020. Based on public statements and interviews with 5 affected individuals by the Associated Press, this month is the final deadline for them to accept investment cuts or losses ranging from 20% to 60%, plunging investors into severe financial distress. The minimum investment amount for Sichuan Trust is very high, generally 300,000 yuan, approximately $42,000. An investor who wished to remain anonymous said, "We are very anxious, this is too cruel, and they have given us too little money back." A relative of an investor stated that among more than 8,000 investors, about 300 refused to accept the bankruptcy restructuring plan and are seeking legal assistance. It was revealed that during the Chinese Communist Party's 2 sessions, some people attempted to go to Beijing to express their dissatisfaction but were stopped by the police. Investors have reported being harassed and intimidated, interrogated by local police, and threatened by their children's employers. They are not allowed to leave Chengdu, and sometimes even prohibited from leaving their own residential communities. Investors disclosed that they agreed to the repayment agreements under coercion. They were threatened with even greater losses if they did not agree by the deadline. Sichuan Trust, the Sichuan provincial government of the Communist Party of China, and the China Banking and Insurance Regulatory Commission have all not responded to requests for comments from the Associated Press. Credit Suisse reportedly dissolves its China Wealth Management division, dozens leave. Insiders report that Credit Suisse has dissolved its entire wealth management team in China, abandoning its plan to become one of the country's largest foreign asset management firms. Sources informed Bloomberg that those laid off include at least 20 client managers and investment advisors, as well as Wang Jing, the CEO of Credit Suisse Securities Venture Capital. Since this matter has not been made public, the sources have requested anonymity. They mentioned that some support positions were also affected, though specific numbers were not disclosed. One source indicated that the department once had about 40 employees. According to an insider, UBS found Credit Suisse's strategy of selling wealth products through banking branches incompatible with its current model, leading to layoffs in the wealth division starting from October last year. As these layoffs occur, Credit Suisse is trying to find a buyer for its securities business in China. After the closure of the wealth management department, Credit Suisse's securities business in China now consists of investment banking and brokerage services. UBS has not yet merged Credit Suisse's entities in China and needs to sell this securities firm, as UBS already controls a securities company in China and cannot hold 2 licenses for the same business. Last year, Credit Suisse postponed the opening of its bank registered in China, marking the second delay of the project since its inception in 2020. The company had planned to establish a network of branches to distribute wealth products and promote its asset management business, joining other Wall Street firms that have invested billions of dollars in China. As recently as 2021, Credit Suisse planned to double its staff in China within 3 years. Insiders stated that the local bank project was delayed due to slow progress in the licensing process. Meanwhile, the project faced scrutiny from some Credit Suisse executives as the Chinese economy struggled with lockdowns and Beijing's crackdown on private businesses during the COVID-19 pandemic. Wall Street firms have seen a slowdown in China due to the economic downturn and a lack of deals. Sergio Ermotti, CEO of UBS, acknowledged during his visit to Beijing in September last year that the geopolitical situation had changed. In an interview, he stated that UBS's direct investment in China's real estate was very limited, and the bank primarily helps people manage their wealth in China. According to a Bloomberg report from September last year, UBS is cutting hundreds of wealth management positions across Asia following its acquisition of Credit Suisse. Insiders mentioned that the cuts would include positions of client relationship managers in Hong Kong and Singapore, most of which belong to the Credit Suisse team. Despite this, the merger still makes UBS the largest wealth management team in Asia, surpassing competitors including HSBC Holdings in terms of assets under management. Don't forget to leave a comment in the section below to share your opinions on today's topic with us. Make sure to like and subscribe to see more interesting topics from China Truths.